Most people's retirements are completely tied to Wall Street. They're completely tied to the stock market. There's no guarantees built in, and it's just up. It's completely exposed to all of the volatility, and that's what we're going to be discussing throughout this video. Okay, so that's just the nature of the financial system. Next, what I want to cover is the false security of traditional retirement accounts. And I'll say this right now, I'm not going to be bashing traditional retirement accounts because I think they have their spot. But when all of your money is in traditional retirement accounts and completely exposed to the market, and especially if you're someone who is more risk averse, more conservative, then that's where I have a problem with this. Some people can stomach the fact that all of their money is in the market and they'll ride the ups and downs of that, and they may have other money, other assets to help when those assets go down or when their retirements go down. But most people don't like to wake up and see their retirement down 10, 20, 30% in some cases. It's just not the most effective way to go about it. So that may be you or may not be you, but that's what we're going to be covering here. Is what I like to call most retirement plans are built on this. It's built on crossing your fingers, hoping that it's all going to work out. Again, I'm not anti-market, but we don't know. We can't say with 100% certainty, I'm going to have this much money at age 70 in my retirement. There's no way to do that because we don't know what the market's going to do. It could be more money than we anticipated. It can be less money. But the fact is we don't know for sure what's going to be in our market-based accounts. We can have a general idea based on how it's done before, but who knows? And something I want to really touch on, and this is not talked about enough, is what's called sequence of returns risk. So this is basically the order in which you experience volatility in your retirement. And I'll give you an example. Someone who retired in 2008 got the short end of the stick. Okay, because they might have experienced a 30% drop the first year they got into the retirement. So if that person had $1 million and they're anticipating to draw out $40,000 a year from that, well, obviously if the market drops 30%, that's a significant reduction in the amount of money they have, therefore affecting the amount of income they can take out. And that's the sequence of returns risk. We don't know what years we're going to experience downturns in the market. So someone who retired in 2008 versus someone who retired in 2017, I'm just making up, or just pull a random date there, a random year, that's going to look completely different. And just one bad year like that can wipe out decades worth of growth. So sequence of returns risk is very powerful, and it's very powerful not in a good way, in a negative way, because it can just wipe you out and completely throw your retirement trajectory off track just from one bad year. And again, we don't know. Obviously, no one has a crystal ball and is going to know when these years are going to come. So it's always a gamble, and that's always something that we have to try to counteract with other strategies, is how do we mitigate the sequence of returns risk. So if you go to retire and your 401k is down 30%, you need to have another strategy built into your retirement plan that you can tap into to allow your 401k in this instance to recover and get back to where it was. You need to have what I like to call volatility buffer, or another guaranteed income strategy that you can draw from and utilize for retirement while your market-based investments are down. And I have another video really deep diving on that, but I just wanted to touch on sequence of returns risk because that is so important to be aware of. Number 3, and this is something none of us have control over, my prediction, I'll get into that in a second, is where tax is going to be. My prediction, based on what we covered earlier in the video with how much debt the country has, is taxes are going to continue to go up. I hope I'm wrong, but I mean, what's the easiest way to start chipping away at that debt? Raise taxes on everyone. So that's something we don't have control over, and we just need to be aware of, number 1, how is that going to affect our retirement? Number 2, are there other strategies we can layer into our retirement that's tax-free? So you pay tax on the seed now, and then you can reap the harvest completely tax-free. And we'll dive into that more throughout this video. And then lastly, just putting more emphasis on just how much damage withdrawals on your market-based investments, or your market-based retirement plans rather, can do to your overall retirement. If you go to retire and there's 2 down years and you're withdrawn from that, I mean, that can drastically impact the rest of your retirement, and you may run out of money sooner than you anticipated. So that's just all stuff to be aware of.